Forex trading psychology. Master your emotions and win. Ever feel like your Forex trading is more of an emotional roller coaster than a calculated strategy? Do you find yourself constantly second-guessing your decisions, gripped by the fear of missing out, or maybe even blinded by overconfidence after a winning streak? Are you losing sleep over trades that just don't seem to go your way, watching helplessly as your account balance dwindles because you just can't seem to control that urge to revenge trade after a loss? If any of this sounds familiar, you're absolutely not alone. Trading Forex can be incredibly exhilarating, but it can also be a breeding ground for emotions that can seriously sabotage your success. We're talking about the crushing weight of fear, the blinding allure of greed, the frustrating sting of regret, and the persistent anxiety that can cloud your judgment and lead to costly mistakes. But here's the good news: you don't have to be a victim of your emotions. In this video, we're going to pull back the curtain on the often overlooked world of Forex trading psychology, the missing piece of the puzzle that separates consistently profitable traders from those who are stuck in a cycle of boom and bust. I'm going to break down, in plain English, exactly what Forex trading psychology is, why it's absolutely essential to your long-term success in the markets, and give you 5 incredibly actionable and practical strategies you can start implementing today to master your emotions, regain control of your trading, and finally trade with a clear, focused, and profitable mindset. We're talking about learning how to identify your own unique emotional triggers, developing a bulletproof trading plan that acts as your emotional compass, implementing risk management techniques that safeguard your capital and your peace of mind, discovering the power of mindfulness and meditation to quiet the noise in your head, and understanding the vital importance of taking breaks to avoid burnout and maintain emotional equilibrium. So, if you're ready to stop letting your emotions dictate your trades and start building a sustainable and profitable Forex trading career, then grab a pen and paper, buckle up, and let's dive in. Because it's time to take control, conquer your emotions, and finally start seeing the consistent results you deserve. What is Forex trading psychology? Okay, so let's get down to brass tacks. What exactly is Forex trading psychology? In its simplest form, it's all about understanding how your emotions, those powerful forces like fear, greed, hope, regret, anxiety, and even overconfidence, are constantly influencing your trading decisions, often without you even realizing it. It's about acknowledging that Forex trading isn't just a logical exercise involving charts and numbers, it's a deeply human activity that triggers a wide range of emotional responses. Think about it this way: the Forex market is a high-stakes arena, a pressure cooker where your money is constantly on the line. Every single trade you make involves risk, and the market itself is in a perpetual state of flux, constantly rising and falling, often in unpredictable ways. This inherent uncertainty creates a fertile ground for emotional reactions to take root. When you're staring at those fluctuating charts, your brain is constantly scanning for threats and opportunities, triggering emotional responses that can easily hijack your rational thinking. To illustrate this, let's play out a couple of common scenarios. Imagine you're watching a trade you've entered start to dip slightly below your entry point. Fear begins to creep in. Doubts start to surface. You think, maybe I made a mistake. Maybe this trade is going to go south. That fear intensifies, and you decide to cut your losses and sell, only to watch the price rebound moments later and soar past your original target. You're left kicking yourself, realizing that your fear led you to make a premature and costly decision. Or, let's flip the script. Imagine you've been on a winning streak. Your confidence is soaring, and you feel like you're invincible. Greed starts to cloud your judgment. You think, I'm on a roll. Let's risk a little more this time. I'm bound to win again. You disregard your carefully planned risk management rules and risk too much on your next trade, only to see it backfire spectacularly, wiping out a significant portion of your hard-earned profits. The sting of that loss brings you crashing back down to earth, a painful reminder of the dangers of unchecked greed. Forex trading psychology is about recognizing these deeply ingrained emotional patterns, understanding the specific triggers that set them off, and developing the tools and techniques to control them before they control you. It's about taking a step back from the emotional whirlwind and making informed, rational decisions based on your trading plan, not on the fleeting whims of your emotions. It's about learning to trade with a clear, calm, and focused mind, free from the shackles of fear, greed, and all the other emotions that can derail your trading success. Why is Forex trading psychology important? So, you might be thinking, okay, Forex trading psychology sounds interesting, but is it really that important? I'm pretty good at technical analysis, and I keep up with the fundamental news. Isn't that enough? The truth is, while technical analysis and fundamental analysis are undeniably crucial tools in your Forex trading arsenal, they're only half the battle. Think of them as the engine and the GPS in your car. You need them to get you started and to guide you in the right direction. But what happens when you hit a patch of black ice? Or when you're driving through a blinding snowstorm? That's where your emotional intelligence comes in. Mastering your emotions in Forex trading is the key differentiator between those who consistently profit and those who end up constantly battling a losing streak. Because let's face it, successful Forex trading isn't just about understanding candlestick patterns or economic indicators. It's about having the ironclad discipline to stick to your carefully crafted trading plan, even when your emotions are screaming at you to abandon it. It's about resisting the urge to jump into a trade based on a gut feeling, even when you see everyone else seemingly making a killing. It's about calmly exiting a losing trade when your stop loss is triggered, even though every fiber of your being is telling you to hold on and hope for a miraculous turnaround. It's about managing your risk responsibly, even when you're riding a wave of euphoria after a big win. Studies consistently show that emotional trading is a primary reason, often the biggest reason, why the vast majority of Forex traders end up losing money. They chase quick profits, they panic at the first sign of trouble, they let their losses spiral out of control, and they ultimately sabotage their own potential. But the good news is that by understanding your own unique psychological biases, those hidden tendencies that lead you down the path of irrational decision-making, you can rewire your brain to make more rational decisions, reduce those costly emotional errors, and ultimately, significantly increase your profitability. Mastering your Forex trading psychology isn't just a nice-to-have skill, it's the solid bedrock, the unshakable foundation upon which long-term, sustainable success in Forex trading is built. Without it, you're essentially building a house on sand, destined to crumble under the inevitable pressures of the market. Know thyself, unlocking your inner trading psychologist. Alright, let's dive into the practical strategies, the real meat and potatoes of this video. And we're starting with the most fundamental strategy of all, the cornerstone of mastering your Forex trading psychology: know thyself. Now, I know that might sound a little cliché, like something you'd hear from a fortune cookie or a self-help guru. But trust me, in the context of Forex trading, it's incredibly powerful. Know thyself means embarking on a journey of self-discovery, becoming intimately aware of your own unique emotional landscape, the hidden biases that lurk beneath the surface, and the specific triggers that can send you spiraling down the path of irrational trading decisions. So, what does this actually look like in practice? Well, it starts with understanding your own emotional triggers. Think about it. What specific market conditions tend to set you off? Is it when the market is highly volatile and unpredictable? Is it when you're facing a string of losing trades? Or perhaps it's when you see other traders bragging about their huge profits on social media? It's not just market conditions, either. External life events can also play a significant role. Are you more prone to emotional trading when you're stressed about work, dealing with relationship issues, or not getting enough sleep? Recognizing these external influences is just as important. The most effective way to know thyself is to become a meticulous record keeper of your trading experience, essentially acting as your own inner trading psychologist. And the key tool for this is a well-maintained trading journal. Don't just record the basic details of your trades, the entry and exit points, the lot size, and the profit or loss. Go much deeper. Meticulously document your emotional state before, during, and after each trade. Ask yourself, what was I feeling just before I placed this trade? Was I feeling confident and in control, or was I feeling anxious and uncertain? Was I motivated by a genuine opportunity, or was I simply trying to chase a quick profit? During the trade, Pay attention to how your emotions fluctuate as the price moves up and down. Are you experiencing a sense of calm and detachment, or are you constantly glued to the screen, gripped by fear and excitement? And after the trade is closed, whether it's a win or a loss, take the time to reflect on your emotional state. Did you stick to your trading plan, or did you let your emotions dictate your actions? What lessons can you learn from this experience? Ask yourself specific questions like, what was I feeling when I placed this trade? Was I confident, fearful, greedy, or something else? Did I deviate from my trading plan due to emotional impulses? If so, why? What could I have done differently? Over time, as you meticulously document your trades and your emotional responses, you'll start to identify patterns and understand your personal vulnerabilities. You'll begin to see the specific triggers that consistently lead you to make emotional trading decisions. And here's the crucial point: recognizing your triggers is the first, absolutely essential step towards controlling them. You can't fix a problem you don't understand. By knowing thyself, you empower yourself to take control of your emotions and transform yourself from a victim of the market into a disciplined and profitable trader. If you're struggling with the emotional side of trading and you're looking for a practical and relatable guide to help you turn things around, I highly recommend checking out this book, The Trading Psychology Edge. You can find a link in the description below, and I truly believe it can make a difference in your trading journey. Develop a trading plan and stick to it. Discipline is key. Alright, let's move on to strategy number 2, which is absolutely crucial for building a strong defense against emotional trading. Develop a trading plan and stick to it. Now, I know that creating a trading plan might seem like a tedious task, a lot of work, but think of it like this: a well-defined and meticulously crafted trading plan acts as your personal trading compass, your North Star in the often turbulent seas of the Forex market. It's your roadmap, your set of predetermined rules that guide your decisions, clarify your thinking, and prevent you from making impulsive, emotionally driven actions that can quickly derail your trading success. Without a trading plan, you're essentially wandering aimlessly through the market, reacting to every price fluctuation and every news headline, leaving yourself vulnerable to the whims of your emotions. So, what exactly should your trading plan include? Well, it needs to be comprehensive and cover all the essential aspects of your trading strategy. First and foremost, your plan should clearly outline your specific entry and exit strategies. What specific technical indicators or chart patterns will you use to identify potential trading opportunities? What conditions must be met before you enter a trade? And equally important, what conditions will trigger your exit? Where will you place your stop-loss order to limit your potential losses? And where will you set your target profit level? Next, your plan must include strict risk management rules. How much of your capital will you risk on each trade? What position size will you use? Will you use a fixed percentage or a fixed dollar amount? Understanding and adhering to these risk management rules is absolutely essential for protecting your capital and managing your emotions. Finally, your plan should specify the exact market conditions under which you'll trade. Will you only trade during certain hours of the day? Will you only trade certain currency pairs? Will you only trade when the market is trending or ranging? Defining these parameters will help you filter out noise and focus on the opportunities that align with your strategy. When you have a clear, well-defined trading plan in place, you're far less likely to be swayed by your emotions. You have a set of rules to follow, a framework to guide your decisions, and a clear understanding of what you need to do in any given situation. Think of your trading plan like a contract, a solemn agreement that you make with yourself. Deviating from that plan means breaking that contract, violating your own principles, and surrendering control to your emotions. Discipline is the key. Sticking to your trading plan requires discipline, but the rewards are well worth the effort. By committing to your plan and consistently following its rules, you'll not only improve your trading performance but also build confidence, reduce stress, and develop the emotional resilience you need to succeed in the long run. So, take the time to create a solid trading plan, and then commit to it with unwavering discipline. It's one of the best investments you can make in your trading career. Implement risk management. Protect your capital. Now, let's move on to strategy number 3, And I want to be crystal clear about this: implement strict risk management. This isn't just a suggestion, it's non-negotiable. It's the foundation of any sustainable Forex trading strategy, and it's absolutely critical for managing your emotions and protecting your mental well-being. Think of risk management as your trading shield, the barrier that protects you from the devastating blows that the market can sometimes deliver. Without that shield, you're exposed and vulnerable, and your emotions are likely to run rampant. So, what does strict risk management actually entail? Well, the first and most fundamental rule is this: never, ever risk more than you can afford to lose on any single trade. I know it can be tempting to chase big profits and take on excessive risk, especially when you're feeling confident, but resist that urge with every fiber of your being. Set a limit, whether it's 1%, 2%, or even 0.5% of your total trading capital, and stick to it religiously. The second key element of risk management is the consistent use of stop-loss orders. A stop-loss order is an instruction to your broker to automatically close your trade if the price reaches a certain level. It acts as a safety net, limiting your potential losses and preventing a single trade from spiraling out of control. Place your stop-loss orders strategically, based on your technical analysis and your risk tolerance. Don't just place them arbitrarily, but think carefully about where the market is likely to move and where your trade will be invalidated. The third essential component of risk management is proper position sizing. Position sizing refers to the number of lots or units you trade in a particular trade. It's directly related to your risk management rules, and it's crucial for ensuring that no single trade can wipe out your entire account. Calculate your position size carefully, taking into account your risk tolerance, your stop-loss level, and the volatility of the currency pair you're trading. There are many online position size calculators that can help you with this process. Now, here's the crucial point that I want to emphasize: risk management isn't just about protecting your capital, it's about protecting your emotions. When you know that you have a safety net in place, when you know that you've limited your potential losses, and when you know that no single trade can destroy your account, it significantly reduces your anxiety and allows you to trade with far greater clarity and confidence. You're no longer trading with a knot in your stomach, constantly fearing the worst. Instead, you're trading with a calm and focused mind, able to make rational decisions based on your trading plan, rather than on the impulsive reactions of fear or greed. So, make risk management a priority, and it will not only protect your capital but also safeguard your emotional well-being. Now, let's move on to strategy number 4, and I know what you might be thinking: mindfulness and meditation. That sounds a little woo-woo, a little too new age for the hard-nosed world of Forex trading. And honestly, I get it. I was skeptical at first, too. But I can tell you from personal experience that mindfulness and meditation are incredibly powerful tools for managing stress, improving emotional regulation, and enhancing your overall trading performance. Think of it this way: Forex trading is a constant barrage of information, a relentless stream of numbers, charts, news headlines, and opinions. It can be incredibly overwhelming, and it's easy to get caught up in the chaos and lose sight of your goals. Mindfulness and meditation provide a way to cut through that noise, to find a moment of stillness and clarity amidst the storm. They help you to quiet the chatter in your mind, to detach from your emotions, and to focus on the present moment. Mindfulness is simply the practice of paying attention to your thoughts, feelings, and sensations without judgment. It's about observing your emotions as they arise, acknowledging them without getting carried away by them, and then letting them pass. Meditation is a more structured practice that involves focusing your attention on a specific object, such as your breath, a mantra, or a guided visualization. It helps to train your mind to be more focused, less reactive, and more resilient. The great thing is, you don't need to spend hours meditating every day to reap the benefits. Even just a few minutes of daily mindfulness practice can significantly reduce anxiety, improve your ability to focus on the present moment, and enhance your decision-making skills. Imagine this: you're in the middle of a trade, and the price is fluctuating wildly. Fear starts to creep in, and you feel the urge to panic sell. But instead of reacting impulsively, you take a few deep breaths, focus on your breath, and observe your emotions without judgment. You remind yourself of your trading plan, and you make a rational decision based on your predetermined rules, rather than on the fleeting whims of your emotions. That's the power of mindfulness and meditation. It gives you the ability to step back from your emotions, to see them for what they are, and to make more informed and rational trading decisions. And the best part is, there are tons of free resources and apps available to get you started. You can find guided meditations on YouTube, download mindfulness apps like Headspace or Calm, or simply take a few minutes each day to sit in silence and focus on your breath. The key is to find a practice that works for you and to be consistent with it. So, give mindfulness and meditation a try. You might be surprised at how much they can improve your trading performance and your overall well-being. Now, let's move on to the final, and often underestimated, strategy for mastering your Forex trading psychology: take breaks and avoid overtrading. I know it can be tempting to spend hours glued to your charts, constantly searching for the next big opportunity, especially when you're on a hot streak or trying to recover from a loss. But the truth is, overtrading is a surefire recipe for burnout, emotional fatigue, and ultimately, poor trading decisions. It's easy to get caught up in the excitement of the Forex market, to feel like you need to be constantly active to make money. But the reality is that less is often more. Quantity doesn't equal quality. In fact, the more you trade, the more likely you are to make mistakes, to let your emotions cloud your judgment, and to deviate from your carefully planned strategy. Overtrading can also lead to a state of mental and emotional exhaustion. Staring at screens for hours on end, constantly analyzing charts and tracking prices, can drain your energy, impair your cognitive function, and make you more susceptible to stress and anxiety. That's why it's so important to prioritize taking regular breaks and avoiding the urge to overtrade. Step away from your computer, get some fresh air, stretch your legs, and clear your head. Engage in activities that you enjoy, that help you to relax and recharge. Get some exercise, whether it's a brisk walk or run, a bike ride, or a trip to the gym. Spend time with loved ones, connecting with the people who matter most to you. Engage in a hobby, whether it's reading, painting, playing music, or anything else that brings you joy. Remember, a clear mind is a sharp mind. When you're rested, relaxed, and mentally fresh, you're better able to focus, analyze the market objectively, and make sound trading decisions. Also, resist the urge to constantly be in the market. Just because the market is open 24 hours a day, 5 days a week, doesn't mean you need to be trading all the time. Patience is a virtue in Forex trading. It's far better to wait for the right opportunities to present themselves than to force trades that don't meet your specific criteria. Only trade when your setup meets your predefined criteria, when you're feeling calm and focused, and when you have a clear plan in place. Otherwise, it's best to step aside, take a break, and come back to the market when you're in a better state of mind. So, prioritize taking breaks, avoid the urge to overtrade, and remember that trading smarter, not harder, is the key to long-term success and well-being. So, there you have it, 5 powerful and actionable strategies that you can start implementing today to take control of your Forex trading psychology and transform your trading journey. We've covered a lot of ground, from understanding your unique emotional triggers to crafting a rock-solid trading plan, implementing ironclad risk management, finding your center through mindfulness and meditation, and prioritizing breaks to avoid burnout. And I want to emphasize this point: mastering your emotions is not a nice-to-have skill, it's just as important, if not more important, than technical and fundamental analysis. You can have the best trading system in the world, but if you let your emotions dictate your decisions, you're doomed to failure. Remember these key takeaways: know thyself, understand your emotional triggers and biases. Develop a trading plan and stick to it, act as your emotional compass. Implement strict risk management, protect your capital and your peace of mind. Practice mindfulness and meditation, find your center amidst the storm. And take breaks and avoid overtrading, trade smarter, not harder. But I also want to be realistic with you. Mastering your Forex trading psychology is not an overnight process. It's a journey, not a destination. There will be times when you slip up, when you make emotional trading decisions, and when you feel like you're taking steps backward instead of forward. That's perfectly normal. Don't get discouraged if you make mistakes. Don't beat yourself up over past failures. The key is to learn from your mistakes, to keep practicing, and to never give up. With consistent effort and dedication, you will gradually improve your emotional control, you will become more disciplined, and you will become a more profitable and successful trader. It's not a matter of if, it's a matter of when. So, take these strategies, put them into practice, and embark on your journey to mastering your Forex trading psychology. Remember that you are not alone, and that with perseverance and self-awareness, you can achieve your trading goals. Now go out there, trade with confidence, and unlock your full potential. What are your biggest emotional challenges in Forex trading? Let me know in the comments below. If you found this video helpful, please give it a like and subscribe to the channel for more Forex trading tips and strategies.